Nancy Pelosi is one of the best investors of all time. In the past year, her portfolio has gained 50%, 2x of the S&P 500. So today I want to go through her top 4 positions, Microsoft, Visa, Amazon, and Nvidia, and figure out these companies' intrinsic values using our 4 valuation models. So moving to the stock screener, let's first have a look at Microsoft. As always, we will plug in the company's ticker and all the metrics will show up automatically. Now to calculate their intrinsic value, I will first jump to the Grams formula revised, where we will take the 5-year earnings per share, the base PE, the 5-year earnings growth estimate, the growth rate multiplier, the average yield on AAA corporation bonds, and the current yield on AAA corporation bonds. Now, before we get to calculating the intrinsic value, we have to plug in the 5-year earnings growth estimate. And as always, I will do that by predicting the high, medium, and low earnings per share estimate. So I will predict the high at 14%, the medium I will go with 12%, and low I will go with 10%. And after averaging this out with the analyst expectations, we will get the 5-year earnings growth estimate at 13.70% every single year over the next 5 years. I will then take all these values and plug them into the Grams formula revised and get an intrinsic value of $268.47, which is actually 34% lower than the current trading price. But we still have 3 more valuation models to go through, so let's jump to our discounted cash flow model, where we will plug in the free cash flow over the past 5 years and calculate an average growth rate of 6.62% over the past 5 years. Now into the future, into the next 10 years plus, I will predict the high growth at 15%, medium at 14%, and low I will go with 12%, and that will give me an average of 13.7%. I will then use this to calculate the future free cash flow. Now to calculate the present value of that future free cash flow, I have to plug in a discount rate, which I plugged in at 7.77% based on the WACC of the company. Now taking this discount rate, I will discount all of that future free cash flow, I will add all of it up, add cash and cash equivalents, and subtract the total debt of Microsoft and get an equity value, which I will divide by the shares outstanding and get an intrinsic value of $374.87, still slightly lower than the current trading price. Now moving to the multiples valuation model, I want to compare Microsoft to 3 of its competitors, Amazon, Google, and Meta. I will take these companies' current stock prices, divide by their earnings per share, and get their PE ratios, which I will average out and multiply by the current EPS of Microsoft to get an intrinsic value of $394.18. Again, a little lower than the current trading price, telling us that compared to its competitors, Microsoft is slightly overvalued. And finally, moving to the dividend discount model, we will plug in the dividend growth of Microsoft over the past 5 years and calculate an average growth rate of 9%. Now into the future, I will predict the high growth at 10%, medium at 8%, and low at 7%, and calculate an average growth rate of 8.33%. I will then take the WACC of the company, the discount rate, and get a negative intrinsic value because our projected growth rate is higher than the discount rate, and due to the mathematics within the model, the intrinsic value comes out negative. But for situations like this, we have the alternative model, which will give us an intrinsic value of $557.31. And so finally, when we move to our ultimate valuation and average out the 4 valuation models, we will get an intrinsic value of $398.71, which is actually almost 3% lower than the current trading price. And so with a margin of safety of, let's say, 10%, we would get an acceptable buy price at $358.84. So personally, at their current trading price, I wouldn't really consider adding Microsoft to my portfolio. But now moving back to the stock screener, let's have a look at the second company on our list, and that is Amazon. So I will plug in the ticker and all the metrics will show up automatically as before. And I didn't mention this yet, but if you want to download these spreadsheets for your own personal use, you can do so at the link in the description. Now I just want to point out 2 things I don't like about Amazon, and that is their high PE ratio sitting at 41.70 and their very high price to free cash flow currently sitting at 75.12. So jumping to the Grams formula, I will predict the high earnings per share growth at 12%, medium at 10%, and low at 9%, and averaging this out with the analyst predictions and taking all these values, we will get an intrinsic value of $104.12, which is 55% lower than the current trading price. Now, I know that Amazon is a premium company. It is in the Magnificent Seven, but I just don't believe that they deserve a PE ratio of 41. But moving to the second valuation model, the discounted cash flow model, as before, we will plug in the free cash flow of the company, and I will calculate a growth rate into the future of 13.7%. I will then use this to calculate the future free cash flow, and plugging in a discount rate at 8.46%, I will calculate the present value of that future free cash flow, and we will get an intrinsic value again of $104.25, quite a bit lower than the current trading price. Now, moving to the multiples valuation, the only change I will do here is change Amazon to Microsoft, and all the metrics again will show up automatically, and we will get an intrinsic value of $160.93 after multiplying the average PE ratios of these companies by the current earnings per share of Amazon. Now, moving to the dividend discount model, we figured out that Amazon doesn't pay out any dividends, so we will skip this one and move straight to the ultimate valuation, where we will average out the three valuation models and get an intrinsic value of $123.10, which is almost 50% lower than the current trading price. So I really wouldn't recommend buying into Amazon right now, unless you do believe that it will grow a lot into the future. But now let's get to valuing Nancy Pelosi's probably most famous position, and that is Nvidia. So I will plug in the company's ticker in, and all the metrics will show up automatically. Now again, something I don't like about this company is, as before, their high PE ratio and their high price to free cash flow ratio. But this could be made up for by their very high revenue, free cash flow, and net income growth. So let's see what their intrinsic value is. When I jump to the Grams formula revised, I will plug in the high earnings per share at 30%. With medium, I will go for 25%, and low, I will go with 20%. And that will still give me an intrinsic value of only $72.19 after averaging this out with the analyst predictions. Now, moving to the discounting cash flow model, again, I will predict the free cash flow growth at 20% highest, 18%, and 15% into the next 10 years plus, and that will give me an intrinsic value of $85.76 after using a discount rate of 9.74%. Now, for the multiples valuation model, I want to compare Nvidia to 4 of its competitors, which would give me an intrinsic value of $214.42. But as 2 of these competitors, Broadcom and Advanced Micro Devices, are both extremely overvalued, for the sake of the valuation, I will actually remove them, and we will get an intrinsic value of only $61.31. Now, regarding the dividend discount model, I will actually not go through this one, as Nvidia started paying out their dividends only in 2024. So based on the little data we have, I really don't think that I can accurately predict the dividends into the future. So I'll jump straight to the ultimate valuation, and averaging out these 3 valuation models, we will get an ultimate intrinsic value of $72.84, which is 45.82% lower than the current trading price. So now that we have calculated the intrinsic values of Microsoft, Nvidia, and Amazon, let's calculate the intrinsic value of Visa. So jumping straight to the Grams formula, I will plug in the high earnings per share estimate at 20%, medium at 15%, and low at 13%, and we will get an intrinsic value of $220.19, which is actually 37% lower than the current trading price. For the discounted cash flow analysis, I will plug in the high free cash flow growth at 11%, medium at 10%, and low at 8%, and calculate an intrinsic value of $344.84. Now, for the multiples valuation, the only company we can really compare Visa to is MasterCard. So after taking MasterCard's PE ratio and multiplying by the EPS of Visa, we will get an intrinsic value of $402.62, which is actually higher than the current trading price. And finally, moving to the dividend discount model, I will plug in the high growth at 20%, medium at 15%, and low at 5%, and we will get a projected growth rate of 13.33% into the future. And again, as this is higher than the discount rate, the intrinsic value will come out negative, so we will use our alternative model, where we will get an intrinsic value of $383.83. And so when we jump to the ultimate valuation and average out the 4 valuation models, we will get an intrinsic value of $337.82, which is actually 3.31% lower than the current trading price. And with a margin of safety of 10%, we would get an acceptable buy price at $304.04. And with that, if I was to add any of these 4 companies into my portfolio, it would certainly be either Visa or Microsoft. And with that, I hope that you enjoyed the video. Let me know your thoughts down in the comments and make sure to leave a like and subscribe, as it really helps me out.